Class is in session. 2020 was one for the history books, with crashing economic output and a subsequent bounce back. In many cases, economic activity is still not at pre-pandemic levels. While 2020 was a horrible year in many respects, from an economic perspective, it could have been a lot worse. Like a student leaving home to go to college, the economy will have to make it on its own without much financial aid in 2021. And like parents saddled with a high debt burden and a mortgage to pay, the U.S. government may be limited in stimulus support going forward. The future of the economic recovery will largely depend on containing the virus and getting workers back to work and consumers back to spending money. The recovery will be uneven, with distinct winners and losers. The stimulus packages helped economies, but it really helped the equity markets. Some equity indices even hit all-time highs during this pandemic, causing equity valuations to be high. Using skills learned in the statistics class, price-to-earnings ratios for large-cap equities haven't been at these levels since the dot-com bubble. But earnings growth next year, while very good, doesn't seem to support these valuations. The high equity valuations come at a time when government bond yields are bouncing off all-time lows. And this creates a challenge worthy of an applied mathematics student. How do investors buffer against possible equity volatility caused by these high valuations? Other parts of the bond market appear overvalued as high-yield bond yields hit record lows, but the high-yield markets may not be as worrisome as some investors believe, and defaults, while expected to be elevated, may not be as high as investors' intuitions. 2021 may be defined by less parental support for the economy. Economies around the world will increasingly have to rely on underlying fundamentals. For our full syllabus of what's ahead, download our 2021 Outlook today.